Hi, and welcome back to the weekly market update for the week of March 1st, 2021. I'm Dennis Morton here with Katie Brown. Katie, how are you doing?
Great. How are you, Dennis?
Good. Welcome to March. In like a lion so far. Today we're going to talk about a couple of things. One is household incomes and the trends that are developing here as the pandemic is starting to wane, but stimulus is still out there. We're also going to talk about Wall Street's latest attempt to create returns for investors without creating any risk and how that's failed yet again. And then we'll wrap up today talking a little bit about some of the things that we're looking forward to on the other side of the pandemic. So, Katie, let's start on the household income side. There was an article in the journal that you found about some of the trends there.
Yeah, it's amazing the increase of household income. So in January, household income was up 10%, which is, outside of the stimulus package that passed last year, this is the highest amount of household income that's ever occurred within 1 month. Much of the income or the increase in household income was from those $600 payments that came out from the last passage of the stimulus in December. And so we definitely saw a spike from that. And so household income went up and spending went up a little bit, but only 2.4%, which is really pointing back towards Americans saving those dollars that they are receiving.
Yeah, and I mean, the household savings numbers are mind-boggling. It's almost tripled in 1 year from what it was in February of last year.
Last February, I think it was 1.4 trillion, and now it's at 3.9 trillion. So it has definitely spiked.
Yeah.
Actually, I have a great chart too that I thought would be interesting to share. We can see, personal income. This goes back to 2015, kind of a steady ride up, along with consumer spending, a steady ride up. But then we have back in first quarter of 2020, where spending dropped off and the economy shut down, and the first round of stimulus checks went out. So income spiked up, and that divergence has really created an opportunity for additional savings, and I think a little bit of pent up desire to spend again going forward. We have the income spike here, as we mentioned, is up 10%, but the spending was only up 2.4. And I do wonder how much of this is being saved for when things open up a little bit more, and how much of it's being saved for emergency purposes and just kind of filling those coffers that maybe weren't as full as they should have been previously.
Yeah, and I think a lot of that spending too is being concentrated in durable things. People are buying cars or large household items, but they're not spending on services. And that's when we talk about the restaurant economy or other places where people actually need to show up and be served. That money isn't showing up yet. So I think there's still some staggered rollout of how that money makes it back into the economy.
Right. But a lot of analysts are pretty positive when looking forward and thinking about the growth potentially for 2021. I know a lot of the growth expectations that I've been seeing are in the 5 to 6% range.
Yeah.
Which it's almost like making up for, last year. We didn't have the same level of growth, obviously, last year because there was such a dampener on so many industries.
Right. I want to bring forward a question that I was asked last week, and this actually changed my mind on something. So I was asked by someone who was frustrated by what they're earning on their cash sitting in a savings account, and they asked, why doesn't Wall Street make something that earns more than cash but is safe? And the answer is they do, and it isn't, yet again. And I think coming back to where my mind has changed, there's a question I've heard asked before, like if you could put anything on a billboard, what would it be? And anymore, I think it's there is no safe 3%. Like if you're going to earn 3% on anything right now, you're taking risks somewhere. Latest example, the Investor IQ, the Infinity Q Diversified Alpha Fund. This is a fund that was billed as a hedge fund for the retail investor, for everybody, that was shut down by the SEC last week, which meant no one could redeem their money, no one could get their money out. The fund was shut down because the SEC found it was too difficult to value any of their holdings. They didn't know what was inside of it. It's a crazy story that was highlighted by Jason Zweig in the Wall Street Journal in his Intelligent Investor column. Katie, what do you make of this Infinity Q Diversified Alpha Fund?
If it sounds too good to be true, it is. If you don't understand it, probably don't want to buy into it. And anytime they say, hedge fund for the masses, pause and take a minute to think. And I think that's the thing. It was this black box filled with different types of investments that literally don't value consistently. They don't have the daily liquidity that you have in most other things in the market, and yet they're trying to market to that. And so the complexity of the investments in there, using different derivatives and different option strategies and everything else to try to boost those returns, that where you really need multiple different valuation models to figure out the value of it, and it just couldn't be done consistently.
And as Weig pointed out in the article, he describes them. It's yet another in a long line of, quote, magical money machines that are supposed to avoid the risks of stocks and bonds and produce magical returns with little risk. So this was billed as a fund that could really wouldn't go down more than 2%. It was going to provide you with stock-like returns. Such a thing doesn't exist. And now investors, some estimates are that people could lose 20% on this fund that was supposed to not lose anything. Sometimes talk about volatility. Stocks can go down 20%. They recover, especially if you're invested in a diversified index. Permanent loss of capital from all 500 stocks in the S&P 500, next to zero probability. But this is a permanent loss of capital of 20%. It's gone. So, and that's the hard part, is that, yes, you've avoided this a little bit, but you've locked in a permanent loss. And that's really unfortunate there.
Yeah. There's another article too that we looked at in Morningstar talking about this same fund. And I think one of the really good points that they made, actually right down at the bottom of the article, was so in Morningstar, it had a silver rating. So it was a pretty positive rating on the fund, but the author made sure to mention that this fund is so small that rating was really a quant rating that was automatically assigned to it. It was too small to have an analyst actually assigned to researching the position and providing that rating. So it highlighted the flaws in accepting third-party rating services for something, and it highlighted where those rating services that are systematic have flaws in them too. So I thought that was really good, because a lot of times I think, all right, it's a strong Morningstar rating, it must be a good fund, but to recognize it wasn't getting eyes on it from true analysts.
Right. And in that same Morningstar article, they highlighted just some of the features of this fund that are consistent with any other fund that's too good to be true. One is that they boast of their institutional pedigree. So, hey, you're investing alongside billionaires. There's cachet to that. It used an investment strategy so complex that management claims could not be independently verified. It held substantial assets that were illiquid, difficult to value. It promised that its investment risk would be unusually low, and it charged a whopping fee for the privilege, over 2% in fees. So if you look at that list of characteristics, is so consistent with all these other things that we see that just don't make sense in the long term.
Yeah, and so eat your broccoli, don't reach for the chocolate cake.
We talk about that. That's how Zweig ends the article. He talks about broccoli versus chocolate cake. What did he mean by that?
Yeah. So, don't look for the shortcut. There is no perfect chocolate cake that's going to make you healthier. But the broccoli, the true steady route, it goes back to, if you want to be better financially set, spend less, save more. Don't try to reach for those magic box returns.
Well said. All right, so concerts were on our mind. We had a concert conversation. Katie and I were actually at the same concert on the same night somewhere in the late 90s. I had no idea. We actually both were at a Rusted Root concert in 1998 that found out years later. So let's talk about concerts you want to see, Katie. Is Rusted Root coming around, or are you going to go see someone else this time?
It's hard to knock them off of the list and favor somebody else, but I think we'll spread out the entertainment a little bit. I would love to see Cage the Elephant again. We've seen them a couple of times, and it's always been just a really great show. Or any live music, for the most part. I'm really missing live music.
Yeah, we have such a great live music culture here with Arts Quest and a lot of great venues. So especially if we can do outdoor stuff, that'd be great. I'm sitting on tickets from last year for the reunion of the Black Crowes. So that was supposed to happen in July, and I'm assuming those tickets will still be good at some point, as long as they can stay together after having broken up for 10 years. So we'll see.
You bring up a really good point. I have to go back through my catalog of things that I register for, like tickets I have just sitting out there for different things, like flights. I know I have a couple of flights that at some point the credits can be applied elsewhere, but I think that'll be interesting too when all of those things start to get cashed in going
Yes.
forward. So
Yes,
no.
I know. That kind of pent up demand. There's that savings rate. Where does that go? How does that get back out into the economy? Well, thanks for joining us. Let us know if there's something you'd like to hear us talk about on a future market update, and look forward to catching up with you again next week.